Hi, and welcome to the Outlook for Emerging Markets and How to Play Them with ETFs, the latest in a series of educational webinars developed by IndexUniverse.com. My name is Matt Hougan, President of ETF Analytics and Global Head of Editorial at IndexUniverse, and I'll be your host for today's webinar. I'm joined today by Kim Arthur, CEO and Portfolio Manager of Main Management, a pioneer in managing ETF portfolios and one of the smartest and most talented ETF-focused advisors I know. I'm tremendously excited for today's webinar because it's the first in a new monthly series of webinars we're doing here at IndexUniverse, which we call the Alpha Beta series. For these webinars, we're partnering with leading portfolio managers like Kim to provide complete 360-degree analysis of how to invest in different asset classes using ETFs. The format today is very straightforward. Kim is going to kick things off with a 15 to 20-minute presentation covering how he approaches the emerging market space, including how he researches the space and decides to over and underweight various countries or segments within that market. In essence, he's covering the alpha part of this series. I'm going to then jump in with the beta portion with my own 20-minute presentation on how to understand, evaluate, and trade emerging market ETFs, looking at the peculiarities that come with them being emerging market ETFs. Following my presentation, we'll open things up for audience Q&A. As a participant in this webinar, you can enter questions for Kim or I using the Q&A tool on your webinar screen. I should say, please don't wait until the end of the webinar to ask questions. Submit them as they come to you. We'll collate the questions submitted throughout the webinar and answer as many as we can at the end. And with that, I'd love to hand it over to Kim Arthur of Main Management to kick things off for us. Go ahead, Kim.
Matt, thank you very much, and thank you to all the participants for taking time out of your day to listen to this Alpha Beta webinar. Wanted to jump right into just a quick little background on who Main Management is so you get an idea of what our level of expertise is to make sure that we're qualified to be having opinions on the foregoing. We're an independent investment advisory firm that was founded in 2002. We typically most of our clients are separately managed accounts, and we're also available on platforms like LPL or Wealthfront or Folios. The investment committee team has over 30 years of industry experience across all types of market cycles. There's 3 of us on the investment committee, and we have full-time 7 people. And we've got an advisory board that's very robust at 7 people that have industry experience. Also, we are GIPS verified for any people that follow the GIPS verification. Our processes and our composites are all GIPS verified. And we have our kind of fundamental proposition is that we view ourselves as active managers of passive indices with a primary focus on sectors and subsectors, styles and size, and countries. We're also big believers in reversion to the mean, so we typically tend to look at things that have been out of favor. And what you need to also realize when you are looking at sectors or countries that are out of favor, you typically need some sort of a catalyst, whether it's a product cycle or a management or regime change for a country, or maybe balance sheet improvements for a country that has gone through a revaluation of their currency and cleaned up their balance sheet. And what we use for the implementation is 100% exchange-traded funds. And what we like about the exchange-traded funds is they're liquid, they're transparent, and they're diversified. So in our little acronym, we've like LTD, liquid, transparent, and diversified. And the other piece is we've been doing this since 2002. And just to give you an idea, over 90% of all the ETFs that are out there now, there's about 1,000, have been created since we began looking at this space using ETFs. And then the last thing, obviously, is we're trying to look to generate alpha using beta instruments. So let me dive into how we kind of approach this. We start from up at the macro level at 30,000 feet, and we're going to work down, and eventually you kind of get to the bottom and do a bottoms-up analysis. So starting from the top down, here's a map, a global GDP growth map. This is from IMF. It's a free site. Anyone can go and pull this. And if you look in the lower right-hand corner of the panel, you can see the emerging and developing economies that are projected to be growing close to 7%. That's versus that's the kind of the tan line. And the line below it are the advanced economies growing at 2.4%. And you can see since 1990 that the emerging economies have always outpaced the developed economies. And there's only that one period back in the late 80s, since 1980, where the developed economies outpaced the emerging. So this is very key, because when you have higher growth rates, it allows you to tackle a lot of things, including, as we'll see later on, if there's inflation, you're able to tackle inflation by tightening rates, unlike economies where they have very low growth rates, like a Japan. It's very difficult, if there were inflation, to tackle it by tightening. The other thing that you'll see here too is real rates are what really matter, and we'll get into that a little bit later. And places like China have positive real rates, where India has negative real rates, so they're probably still a little too loose with their monetary policy. Okay, what this shows, the next thing that you need to keep an eye on is not only do you have the macro events of the, how the economies are growing and what's happening with inflation, but there's obviously the flow issue that happens when people get excited about certain asset classes. Obviously money flows in. When they get fearful, they start to take money out. And what you can see from this slide, this is from ETFR. They are a provider of flows of information into flows of assets into different asset classes. And since the beginning of the fourth quarter of 2010, you can see that the flows into the developed, that would be the red line, has been north by northeast, up to the upper right here. And conversely, the crossover point for the emerging, which is the dark green line, the third week of January, you began to see outflows, and those outflows obviously coincided with fears of inflation, fears of political unrest. And what's interesting is on the developed side, we've had year-to-date 50 billion of inflows. Just to comp that, the comparable time frames for 2009 and 2010 had 20+ billion of outflows. So you've got a delta of almost $70 billion already right off the bat here. Whereas the emerging markets, all of last year for 2010, they had 100 billion of inflows. So we've already had a fifth of that money that's flowed out here in the last month and change. And the other two panels, or the other two lines in there, show the dark blue are the bond flows, which have basically kind of been pretty stable. And a lot of the source of funds, besides the emerging, have come out of money market funds, which obviously are yielding zero. On the next slide here, what this shows is you can see here, this is specifically just for emerging markets. So it's taking that last panel, and now we are shooting into a longer time frame for the emerging markets, going back to January of 2007. And what you can see, if you look at that spike down that we had happening on the 18th of January, that was the biggest outflow that we had seen since July of 2008. So 2.5 years prior to that. You can also see during that period from July of 2008, there was an extended period of outflows. Now, that did coincide with the entire, crises that erupted with Lehman and Bear Stearns and all of the rest of it. So they are slightly different, but probably what's important to key in on that is during that 6-month period back in 2008, when you had outflows, the emerging market versus the S&P 500, there was 15 points of underperformance, 15 points of underperformance that happened. So the emerging markets were down 40+, the S&P was down just less than 30. Currently, just from the beginning of the year, the emerging markets are down about 6 points, and the developed, or the S&P, is up 4, so you've got about a 10-point delta. So the point here is just that flows can be erratic. You can't always you can't always figure out what's going to happen, but you definitely need to kind of have an idea of what's happened and what could potentially happen going forward. As we then look here, the next thing that's obviously very important, we've talked a little bit about growth rates, we've talked a little bit about flows. You obviously also have to talk about valuations, because valuations do matter. It is very apparent that the emerging markets do grow at a higher rate, as we saw earlier on, but it's also very important to find out how the valuations are relative to the developed markets. So what this slide shows you is that over the last 4 years, the emerging markets have averaged about an 11% discount on a forward PE basis to the developed markets. They're currently at a 14% discount. So they are cheaper than they've been over the past 4 years. You can also see from this slide at the bottom in the fourth quarter of 2008, so at the bottom of the crises, the emerging markets actually traded at a 30% discount. And that was preceded at the peak in the summer of 2007 when they traded at a 1% premium to the developed market. So again, from this, it kind of gives you an idea here that you're somewhere, you're slightly below a historical valuation. And the question then is that discounting the political risk? Is it discounting the inflation? Is it discounting the flows? So again, this is part of the whole process of kind of putting all these different pieces together and trying to feel, where exactly you are. Now what we start to look at as we've moved through, we're now going to start taking the emerging market. It's not one homogeneous entity. It has different parts to it. So the first piece to look at would be looking under the covers here and taking a look at the different regions that make up the emerging markets. And that way you can take a look and see, sub-Saharan Africa, or you look at the northern part of Africa, or you can look at Europe, you can look at the Far East, you can look at, segments inside of the Far East. So there's lots of ways to chop it up. In this one here, we're looking specifically at MSCI, their country indices, and the different ways that they break it up. And if you look in the bottom third of the slide, you'll see the emerging markets that we've boxed. That gives you a benchmark as to how the other segments are valued compared to it. And what we have across the top panel there, we've got price to book, price to earnings, price to cash earnings, dividend yield, return on equity, and earnings per share. Keep in mind, too, that the return on equity, that number is based upon a 1 times price to book. You'll see in a later slide here that we make an adjustment for, obviously, if a region or a country is trading at a multiple of its book value, you need to adjust that return on equity, because you don't get, as a buyer of that piece, you do not get the entire return on equity or profitability if you're paying above book value for it. So again, looking at the emerging markets as your benchmark, you see they're trading at 2 times price to book. They've got a PE of about 14.2 times. They've got a dividend yield of about 2%, and they have a return on equity of 14 times, which on an adjusted basis you'll see is closer to about 7. So what this gives me now is now I can look, and I look at below that at emerging market Europe, which is essentially Russia and Poland that are investable, that you can find ETFs that you can invest in. It also includes Hungary, Czechoslovakia, which there are not ETFs available directly to get pure exposure. But you can see that based on that, where EM Europe trades at 1.4 times price to book, or a 30% discount, and on a PE basis it trades at just over 9 times, or a 34% discount. So at least this gives you an idea when you're kind of mining. Think of yourself, you're going out there, panning for gold, and you found an area that historically, valuations here show you that it looks cheaper, that there was gold bars or gold nuggets that are available. The emerging market Europe is a place to begin, begin your process. If we look up at the top of the page here, we've got the BRICS. The Brazil, Russia, India, and China. And if you look at their valuations, they're about in line with the emerging markets as a whole. The price to book is right on it at 2 times, and actually the PE is at a slight discount. about a 7% discount to the emerging markets. And then the return on equity and the dividend yields are probably right in line. So again, this is kind of a roadmap to figure out where you want to go to try to find inexpensive, or conversely, you want to find out where maybe things look a little expensive, and maybe if you've got exposure there, you'd be looking at trimming things back. Now, after you look at the different regions, obviously inside of each of those regions would be the individual countries that constitute it. So we've drilled down further now, going from the emerging markets as a whole. We've then touched on the different regions. Now we're going down to a country level. So at a country level, if you look at the top, we've added 2 new columns. The first one is a PE to growth rate, or commonly known as a PEG ratio. So this gives you an idea of looking, obviously, because the PE, you need to find out how that's growing. Higher, faster growing countries or faster growing individual securities are typically going to be afforded a higher multiple, a higher PE. So this is a way to kind of bring it down so that you can look at it on an apples-to-apples basis. So again, at the very bottom of the page, you'll see the emerging markets boxed again. Its PE to growth rate is about 2.4 times. And you can see when you run through that panel there, you've got ones that are as high as Mexico at almost 6 times, because that's a combination where it's got a higher PE than you do have for the emerging markets, and it's got a lower growth rate than you do have for the emerging markets as a whole. And then you get it to the very top of that panel, China, which actually has a PEG ratio of 1.5 times, because it's trading at about in line on a P basis at 14 times, but its growth rate is almost 2x what you would get out of the emerging markets as a whole. And the other adjustment that we've made is over on the right-hand side, third from the end. That was the one I had mentioned earlier, where we've taken that return on equity and we've divided it by your price to book value to get an adjusted return on equity. And again, this is very important because it can be misleading if you look at it and think that you're getting 15% for your return on equity, but if you're paying 2 times price to book, you're not quite getting that. So we've made those adjustments, and again, as we go through here, we can see again that Russia looks very inexpensive, trading at it trades at a 13% discount on the PEG ratio. It trades at a significant discount on a PE basis there at 8 times versus 14 times for the emerging markets. And on that adjusted return on equity, you're getting almost 12% versus 7%. So at least, again, that's another good starting point before you start to talk about inflation and political risks and various other things. Conversely, you can see at the top of the page where India, which has obviously had a rough year to date here, it's down about 16%, where the emerging markets are down about 6%. You've got India, which trades at a 4% premium on the PEG ratio. It trades at a 50+% premium on the price to book. It trades at a 40% premium on the PE, and its adjusted return on equity is a third less than the emerging markets. So there better be a very, very, very good reason to be involved in India, because on a valuation basis, it's not like it's undiscovered. And that's again what you're trying to look at here. And obviously, again, these are all pieces you're kind of looking at. We've got Brazil on there, which looks like it's kind of right about in line with what's going. It looks like it's slightly cheaper. Its growth rate tends to be a little bit lower than the emerging markets as a whole, which is why its PEG ratio looks a little bit inflated. Flipping to the next one, what we now have done is we've gone one level deeper now. We've gone from the countries. You're now going to the individual sectors. So these are the emerging market sector levels as a whole. And again, you've got the same valuations, price to book, PE, price to cash flow, dividend yield, and return on equity. And these are the 10 GICS, the Global Industry Classification Standards. And you can get these across for the U.S., for developed, or for the emerging. But these are typically, consumer discretionary. Those are things that you're clothing, for instance. Consumer staples would be toothpaste and shaving cream. Energy and financials and healthcare are pretty self-explanatory. So this is a good way to look at the sector weightings to see what you have and the valuations, again, the valuations that happen here. And if we take two things, for instance, look at energy, and at energy you've got it at 1.5 times price to book. To give you a reference point there, the U.S., if you look at the U.S. price to book is 2.3 times. So in the emerging markets, it's cheaper. On a PE basis, it's 10 times, where the S&P trades at 16 times. On a dividend yield, the S&P energy sector is 1.6%, where this emerging is 2%. And on adjusted return on equity, the U.S. is at 6.4, and the emerging is a 9.8. So typically, most of those emerging economies have monopolies for energy, so that helps them out. But it also shows not only do you have a monopoly, but you have cheaper valuations, as opposed to healthcare, which is right in the middle of the page there. Healthcare is trading at 4.3 times in the emerging markets, where the U.S. is at 2.5 times on a price to book. And the PE in the emerging markets is 23 times, and it's 14 times here. So typically, this is another thing that we would look at, and we would say, I think I want to avoid countries that have excess exposure to the healthcare sector, because that looks like it's too expensive. Again, keep in mind, we're reversion to the mean. If someone were a momentum player, they may love that. They may love the fact that this is expensive because they think it could potentially get more expensive. But again, with our thesis being reversion to the mean, we like the energy, and we would be avoiding, or underweighting the healthcare based on this valuation. So flipping to the next slide, this is kind of going down now to looking at valuation, where we talked about earlier. Valuation matters. So here's an example of something that we had owned for a while and have trimmed back the position significantly. And the reason is the circles that you see are the top panel here is price only for India. The next panel shows a PE basis. They call it an earnings yield, but that's the inverse. It's a PE. And the bottom panel is a price to cash earnings. And you can see on those circle ones there, specifically on the earnings yield one, you could see that back in 2009, India was 2 standard deviations below its historical valuation, i.e. it was cheap. And on a price to cash earnings, it was 3 standard deviations below. So that immediately pops up, being again reversion to the mean. If we can find a catalyst, sometimes you don't need a catalyst if it's that cheap. We went ahead and started to build positions into India. You can see what's happened subsequently over the last couple years now is India, in every metric that you look at, if you're below the green line in the middle there, the area below that is expensive, the area above is inexpensive. So in every metric possible, it is expensive still. We saw that earlier in the panel where we showed the different countries, and this just graphically shows you going back historically. So it gives you a little more time going back to 1995. So now you can see that it's been more expensive in a couple other periods there, particularly back in 2000 and then again in 2008. So, but this is one of the tools that we again use. One of the things that's happened here from 2009 to present, you've had the India markets up about 100%. The emerging markets are up about 80% over that time. So you've gotten some outperformance. Of the 100%, about 14% of that gain has come from currency. The Indian rupee has appreciated during that time. So you can tell here, year to date, what's happened is you're getting some reversion to the mean, where India is down 16% on the year, and the emerging markets down 6%. So reversion to the mean is happening right now. Flipping on to the next page. This is just talking about inflation inside of India, and what you can see here is the red line. The red line shows you the performance of the Indian stock market. The blue line shows you the interest rates. And what you can see has happened here is since 2010, you've had rates, short-term rates over in India, 1-month rates have more than doubled from less than 4% to 8%. So they're in the process of trying to battle inflation. The problem is, as I mentioned earlier, the real rates over in India are still negative. They're minus 270. So that means it's still, money is still freely available, and that's an issue. So what's probably going to happen is that rates are going to continue to have to go up to fight inflation over there. And you can see what happened back in the '08 period as they took rates above, as they kept ratcheting rates up, the stock market went down, down, down. Now that time frame also coincided with the entire global crises, but the point is that negative real rates are not a good thing. When you have inflation moving ahead, it means that rates are going to have to go higher and multiples are going to come in. On to the next page here. This is why inflation really matters in the emerging nations. We've all seen and heard this, that typically in general, energy and food are 2 to 3 times what they are here in the U.S. The U.S., it's about 14% of the CPI, the Consumer Price Index, is food, but in the emerging markets, it's on average 31%, and then you get in some areas like Peru and the Philippines and India, it's almost 50%, 50. The U.S. also, a lot of the food cost is actually packaging, so if you look at the raw material, some people would say that it's less than 5% of the CPI. So it really matters overseas, and as we know in these emerging markets, people, if they can't get food at a reasonable price, they will riot in the streets. Looking on the next one here, this is another piece that we look at here, and I put specifically India down here. These are population pyramids that I'm sure you guys have seen. If not, go to the U.S. Census Bureau. You can get all kinds of fancy pictures on them. And what this will show you, a lot of the emerging market countries, including Brazil and India, Mexico, Turkey, Peru, Egypt, Colombia, Malaysia, they all have these beautiful pyramid shapes. Ironically, if you went back to Japan in the late 60s, they look like this too. And then they all of a sudden, the bubble from the bottom kind of is moving up in places like Japan where they do not have a pyramid. But this is a good long-term predictor because remember, for GDP, one thing that's a constant and that's an assured piece there, if you have population growth, that's going to help out your GDP a lot. So that's one built-in factor that all of these emerging countries that have these pyramid populations helps them quite a bit. And specifically with India, we're still looking at 8% growth, so it does have the issues of inflation and negative real rates, but it does have that 8% growth, so it is able to raise rates and still kind of battle it and still have growth that can come out of it. This next one here is Russia, and the reason I put this down is, again, we saw earlier that Russia looks very, very inexpensive on a lot of metrics. The one thing that is a little interesting here is they're behind the 8 ball for raising rates here. They've got negative real rates of about 400% right now, and what's 4 points. And what's happening here is so that's a big cautionary piece to keep in mind. But what's helping them out there, and there's a mistake on this slide, I apologize. The Russian equities, they're actually more than 35% below their 2008 peaks. The slide says 10%, but they're more than 35% below. Just to put that in perspective, the emerging markets are about 20%. So Russia is still down quite a bit more off its 2008 levels. The one piece that you want to be careful with is that the rates, they haven't tightened rates as much as they should, but they do have a weapon in their back pocket. Remember, Russia is the 2nd biggest exporter of oil behind Saudi Arabia. They export about 7 million barrels a day. So at the current prices, that's about $700 million of cash that they have coming in on a daily basis. So this is a big weapon for them to have. Going on to the next slide here, this also just shows one other piece inside of Russia where you look at their balance sheets. I'd mentioned earlier that you want to try to find for a catalyst if there's a balance sheet or a regime change. In this one here, you can see at the bottom here in 1998 when there was the Russian currency crisis, they basically devalued their currency and they repudiated their debt and they hit the reset button. And you can see what's happened there is that the debt dropped dramatically their gross external debt as a percentage of GDP. So from a balance sheet standpoint, they've cleaned themselves up significantly, and that's also a good thing. Just like a personal balance sheet or a stock balance sheet or a country balance sheet, it does all matter in the long run. This is, oh, actually, I think this is a, we're missing two slides. Whoops, sorry. We're missing a slide here that's, I apologize there, you guys. Let's see here. Sorry here, let me flip. I apologize. There's one slide that's not on here that I'm trying to look for. I'm struggling through this. I apologize. But I wanted to just give you guys an idea of the types of sources that we use, and just to tell you on those things, we've gone through here, but we have a lot of sources, including Ned Davis that we pay for, MSCI that we pay for, Leuthold that we pay for, investment banking relationships with the street that you can either, we have existing relationships or you pay for, EPFR that we pay for, but there's also these free sites that I've mentioned to you guys. International Monetary Fund, IMF.org you can go to, the CIA World Factbook that you can go to get all kinds of information. There's also the ETF content providers that has availability, and then there's also the U.S. Census Bureau. And then the last piece that we have up here is just a listing of the different ETFs that are available for you to use. There's essentially there's 21 different MSCI emerging markets there. There's individual ETFs that cover 18 of those 21. Czechoslovakia, Hungary, and Morocco are not available. Then on the frontier side, you can get the Gulf states and you can get Vietnam. So there's about a dozen plus ETF providers that Matt will go into more details about. So you've got lots of availability all the way from First Trust to Power Shares to Index IQ, and obviously iShares for one of the big guys, and Market Vector. So there's all kinds of availability across that. And with that, I want to turn this back over. And
thanks so much, Kim.
Sure.
I think that was just great. That was just great. I want to remind the audience that if you have questions for Kim, please enter them into the Q&A session on your screen. We'll collate those and answer those at the end. But Kim, I think you did just a great job reviewing, how investors should approach this market. From my perspective, I really think there has been a sea change in how investors are being forced to think about investing from sort of traditional single stock analysis to that sort of macroeconomic big picture analysis that you were focused on. And I think people need to learn that framework. So I found that hugely useful. I'm going to answer one question that's coming up a lot. All of Kim's slides as well as all of my own slides will be available tomorrow on IndexUniverse.com, and everyone who registered for this webinar will receive an email linking you to those slides. So rest assured you can study Kim's slides in depth tomorrow. So before we get to the Q&A, I want to take a few minutes to dive into the other half of the problem, which is, once you've done the kind of analysis Kim suggests and you've found the market you want to invest in, how do you evaluate and trade the ETFs that exist in that market? I think it's a real issue. A lot of investors think that ETFs just work, that they track their indexes, they trade in line with fair value, they're fully transparent. But that's not always true. ETFs are really just a wrapper. They're only as liquid, transparent, and functional as the securities they hold. And for obvious reasons, it can be more difficult to own a small cap stock in Vietnam or Russia than it is to own Cisco or Exxon in the US. So that makes emerging market ETFs a bit more complex and means you have to spend a bit more time evaluating them. You can really get a feel for this just by looking at the history of emerging market ETFs in the US. The first emerging market ETF was launched in 2002 when PowerShares came to market with the Builders Emerging Markets 50, or ADRE. ADRE got around the problem that ETF providers were having of accessing emerging markets simply by using ADRs. Those are New York listed shares of securities that trade in overseas markets. if you buy ADRs, you get around the problem of actually accessing stocks in China and Egypt and markets like that, but you end up with random exposure. So in this slide, I've looked at the weights for ADRE, the ADR-focused emerging markets ETF, and the second emerging market ETF to launch, which was the iShares Emerging Markets ETF, EEM, which provides exposure to locally listed shares. And you can just look right down that list and see how that made a big difference. ADRE severely overweights Brazil and India and underweights China, Russia, and Taiwan. We've seen a huge amount of ETF innovation since then. We've seen ETFs launch covering small caps, emerging market debt. The first emerging market currency ETF launched a few years ago. And I see more coming. I've heard talk of emerging market commodities ETFs, which would buy commodity futures on exchanges in China. I've heard talks of CDS rate emerging market ETFs. There are in total about 113 emerging market ETFs right now, with 158 billion in assets under management. And as you can see on this chart, those assets have skyrocketed over the past few years. Kim mentioned that emerging market ETFs provide exposure to 18 emerging market countries. I've listed them here along with Vietnam, a frontier market country that often gets lumped in with the emerging markets. There are now ETFs that provide coverage of 99% of the market cap of the emerging market world. You'll notice on this slide that I put a question mark by Korea because some index providers consider that emerging markets and some consider it a developed market. We'll dig into that later. But I just want to focus for a minute on how incredible this list is. I mean, you're looking at countries like Indonesia and the Philippines, which are markets we couldn't have dreamed of accessing a few years ago, and now here they are ready for investment. But I do want to emphasize, and we'll get into this, that these are still emerging markets, and as we're seeing in Egypt and elsewhere, investors who forget that do so at their peril. So let's talk a bit about how to evaluate these exotic emerging market ETFs. As many of you know, here at IndexUniverse, we've been working on a systematic framework for evaluating ETFs. And one of my favorite aspects of this methodology is just its acronym. It's simple to remember. It's ETF. Now, most of you know ETF is standing for Exchange Traded Fund, but I want to switch that mindset and think of it as efficiency, tradability, and fit. And let's hit emerging markets with that in mind. When we talk about efficiency and when you approach evaluating emerging market ETFs, we mean something really simple. Does this ETF deliver on its core promise to investors? If a fund says it gives you exposure to the Indonesian market, does it actually give you that exposure? And the place to start, we think, is with expense ratio. Now, study after study shows that expense ratio is the largest single determinant of returns. And while there are some emerging market ETFs with low expense ratios, such as VWO, the Vanguard Broad-Based Emerging Markets ETF, which charges 22 basis points, by and large, emerging market ETFs skew to the expensive side of the market, with some, like the Market Vectors Egypt Fund, charging close to 1%. The reason for that is simple. Settlement, trading, commissions, conversion fees, it's all more difficult to do in emerging markets, so you see a bigger spread in emerging market expense ratios than you do in the U.S., and it makes sense to pay attention. For all that talk of expense ratio, however, that's ultimately not what matters. Ultimately what matters is not what you pay, but what you keep. And for that, you need to look at tracking performance. As a rule, tracking an index is more difficult in emerging markets than it is in developed markets for the same reasons I mentioned earlier. Emerging markets are difficult to access with illiquid securities, capital restrictions, and other factors. We think the best way to look at tracking performance is to look at rolling 12-month windows, measuring the difference between a fund and its underlying index over rolling 12-month snapshots. That way you can look at an investor's experience over a year or 2 years. This chart compares the rolling 12 months tracking difference for two funds, VWO and EEM. Both are broad-based emerging markets ETFs. Both track actually the same MSCI Emerging Markets Index. And you can see that their tracking difference is very different. An investor in VWO has stayed around 1% off the index, while EEM investors have been further removed. Charts like this, which are easy to calculate, give you a feeling for the best, worst, and average experience an investor has in these funds. If you look at the beginning of that chart, you'll notice the spike in EEM's tracking difference. That's because EEM at that time was what is called heavily optimized. Rather than owning all the stocks in the underlying index, it only held some of those securities. Now, iShares did that to make the fund more liquid, and indeed, EEM is one of the most liquid securities in the world. But if you optimize, underweighting some areas and overweighting others, you run the risk of significant tracking error if those optimizations go against you. VWO fully replicates its index, and you can see how that translates into better tracking. More recently, EEM has come to more closely replicate its index, and you can see that its tracking performance has come in. Let's turn now to the T part of the equation, tradability. There are two ways to look at the tradability of ETFs. You can look at the liquidity you see on screen, or you can look at and think about the liquidity that exists in the underlying securities of an ETF, and both are important. If you're a smaller investor, the liquidity you see on screen is of primary importance. You should focus on ETFs that trade at tight public spreads and have decent trading volume. If you're a larger investor, the underlying liquidity of the ETF's holdings is more important, as market makers will create liquidity to meet large-scale investor demand. There are plenty of examples of ETFs that trade only 1,000 or 2,000 shares a day, which then print trades for 100 or 200,000 shares right on the offer because an AP was able to tap into the underlying liquidity of an ETF. So what does ETF liquidity look like? This level 2 quote for AFK, the Africa ETF, was struck around 10:30 a.m. today. You can see that the ETF is trading about 9 cents wide with decent size on the offer. Not surprisingly, that 9 cents is more than you would see in a fund like the Spiders or most developed market funds. Spreads tend to be higher in these emerging market products. The biggest single determinant of a fund's spread, and therefore of the fund's cost to trade, is the AP's ability to hedge the creation-redemption basket. In the case of large-cap, broadly diversified emerging market ETFs like EEM or VWO, this issue is minimized by the deep liquidity of those portfolio constituents. The further you travel along the size spectrum into more exotic markets, the more difficult it gets. It may be extraordinarily hard for an AP to access, say, a small-cap stock in Peru compared to a large multinational firm like Samsung. So you see this when you try to trade large amounts of shares of EEM or the Peru ETF. One interesting wrinkle in all this is simply timing. All else equal, it's more challenging for an AP to arb a fund which has underlying securities that are not trading during the U.S. trading day. Imagine that an order comes in for a Chinese ETF. The Chinese and U.S. equity markets don't overlap at all. If an AP gets an order for a Chinese ETF, they must use some other tool, like a futures contract, an option, another imperfectly correlated ETF, to hedge exposure until they can actually buy the underlying securities. That will show up in greater trading costs. There's actually a rumor in the ETF space that ETFs like EEM or AFK trade tighter in the mornings when more of their underlying securities is open. We did a big study of this, and it actually turns out it's not true for small trades. There is no particular pattern of trades spreads widening for intermarket spreads. But that's only for small orders. If you call an AP and want to trade, say, 100,000 shares of PLND, the Poland ETF, you'll get a better deal at 9:45 New York time when Polish markets are open than you will at 1 p.m. when they're closed. While both on and off-screen liquidity in emerging market ETFs is generally pretty good, we can't say the same for premiums and discounts. Premiums and discounts are widely misunderstood in the ETF space, or to be more direct, everything you've ever seen or heard about premiums and discounts in emerging market ETFs is basically wrong. All ETF sponsors publish on their site a list of premiums and discounts. They take the closing price of an ETF, subtract the NAV, and arrive at the premium or discount. In theory, it shows how close a fund trades to its underlying value, and it works great in the U.S. market, where the ETF and its underlying securities trade at the same time. But what happens in China? This chart compares the trading price of GXC, the Spiders China ETF, to its indicative NAV, the estimated value of the underlying net asset value that the fund must publish every 15 seconds throughout the trading day. I know a lot of investors look at the INAV to gauge if they're getting a fair price for the ETF. But you'll notice in this chart that the INAV for GXC doesn't move much during the U.S. trading day. Rather, it jumps around in stepwise fashion. That's because the underlying securities of GXC aren't trading during U.S. market hours, so the NAV can't update. This leads to false impressions that an ETF is trading away from its market. GXC may trade down 2% on a given day, and it will look like it's trading at a 2% discount, but that's a mirage because the NAV just isn't updating. You can see this best if you look at the upper right corner of the chart, where the INAV flatlines for 3 days. That's not an error. That's actually the Chinese New Year when the underlying markets closed, but GXC kept trading right along. Because the INAV for these funds is essentially useless, investors in emerging market ETFs have to have some element of faith that the pricing is accurate. For me, that puts a premium on highly liquid ETFs, where you can be sure that a lot of smart people are looking at the fund and arbing any price discrepancy. All that said, it's important to remember that these are emerging markets, and funny things can happen. This chart shows the premiums and discounts of the iPath India ETN in 2007 and 2008. You'll see that much of the time the premium and discount ping-pongs around 0, but then it explodes to the upside over the winter months of 2007. That is not the result of mistaken timing. That happened because the Indian government put capital controls in place, limiting the flow of new money into the country, ostensibly to cool down what was an overheated market. When that happened, iPath actually shut down creations for the ETN, meaning no new shares could be created. Limited supply ran into significant demand, and the fund spiked to a 25% premium. That's hugely risky, especially if you bought at that point, because once creations reopened, the entire premium collapsed, and you would have lost that money. Here's one last slide related to premiums and discounts. It shows the chart of the world's only Egypt ETF, EGPT, which is the dark blue line at the top of the slide, as well as the performance of 3 London and Canadian cross-listed Egyptian securities. I think this is a great slide. When the Egyptian protests erupted in late January, the local Egyptian stock market closed. EGPT responded by closing the door to new creations, just as INP did in India in 2007. There were a million stories in the press about EGPT trading to a premium since its price rose after the Egyptian market closed. That was nonsense, though. The underlying market was closed, so it's impossible to say what premium or discount Egypt had. If you look at this chart, you can see that the ETF actually got things about right. Right through middle of February, EGPT traded more or less in line with the shares of Egyptian securities that were trading in London and Canada. But a funny thing happened over the past few weeks. The London-listed Egyptian shares tumbled as unrest spread in the Middle East. Meanwhile, EGPT stayed flat. Why? One reason is that the ETF had huge inflows the day before it closed its creation window, with fund assets almost doubling. Van Eck, the fund sponsor, was unable to put this money to work in the local market, so EGPT has been sitting on an almost 35% cash position ever since. That's paid off in recent days as the fund is flatlined while the underlying securities tumbled. The lesson here, always look at the underlying and look at what the fund is actually holding before you buy. If tradability matters in emerging markets, fit actually matters more. And by fit, we mean something very basic. Does this ETF give you the exposure you want? I'll walk through a few slides showing that the emerging markets exposure in ETFs can vary wildly, and then we'll open it up for Q&A. I mentioned earlier that no one really even agrees on what an emerging market ETF is, or emerging market country is. Different index providers have different standards, ranging from GDP per person to capital convertibility to a variety of other metrics. The proving ground in that right now is Korea, which MSCI still classifies as an emerging market, even though other providers consider it developed. This chart shows 2 leading emerging market ETFs, EEM, which tracks an MSCI index, and GMM, which tracks an S&P index. You can see how the Korea issue divides them. EEM plows nearly 14% of its portfolio into Korea, while GMM has 0. That makes EEM a more developed fund than GMM, and that shows up in both risks and returns when you look at performance. Another quick example of how this country-based exposure can differ wildly is the 3 BRIC ETFs. If you just look at the Russian exposure on this chart, you can see it ranges from 2% for EEB to 22% for BIK. Tweaks in weighting strategies also impact country exposures. Investors, I think, in the U.S. are familiar with how market cap, equal, and fundamental weighting strategies can impact sector and size and style tilts. But when you apply those same weighting strategies to international ETFs, you get bigger differences in country exposure. So this chart looks at 3 broad-based emerging market ETFs that use equal, fundamental, and market cap weighting strategies. You can just scan across the top line and see how the FTSE-RAFI fundamental weighting strategy massively overweights China while underweighting India and Korea. The knock-on effect on sectors still occur. In this case, VWO, the market cap weighted fund, has just 15% of its portfolio in emerging market companies, while the other 2 ETFs have about 30% each. But the difference between these weighting strategies is actually bigger in the international space because you have the knock-on country effects as well. One final note on correlations. There's been a lot of discussion of the rising correlation of emerging and domestic equities, and it's certainly true. If you look at this correlation matrix and read across the line for the Vanguard Total Market U.S. Fund, VTI, you can see that a broad-based emerging market ETF like EEM has a monthly correlation of 0.88. You can do slightly better by moving down the capitalization spectrum to a small cap fund like EWX, and you actually do even better if you move into frontier markets or specifically into the Vietnam fund. But of all those, the most appealing to me is the small caps. I definitely want to hear Kim's thoughts on this. Most emerging market ETFs, including VWO and EEM, the 2 biggies that most people own, explicitly exclude small cap stocks. The indexes they track only hold the top 85% of the market capitalization of the countries they cover. One would expect that by focusing on large multinational firms, you would get funds that are more tightly correlated with the U.S. market, and that's indeed what we saw. There are a million ways to make the point that small caps may give you more interesting exposure, but I wanted to take a simple approach and compare the top 10 holdings of the large cap focused EEM with the top 10 holdings of the small cap focused GMM. My point here is very simple. If you're like me, you recognize the names on the left, names like Samsung or Petrobras or Taiwan Semi, but you may not have ever heard of Empresas La Polar or Thanachart Capital or TV Azteca on the right. I think when you're searching out low correlations, to some extent the anti-Peter Lynch rule applies. Own what you don't know. And with that, I want to open it up with questions. I'll remind everyone that you can enter questions for Kim or I into the Q&A section of the webinar tool. But I want to take a chance to ask Kim a few questions of my own. So Kim, let's start out actually with that last slide. You know, I mentioned that small caps give you perhaps a little bit better correlation benefit. You didn't talk much about size in the emerging market space. What do you think about the new small cap and mid cap funds that are popping up around the world?
Yeah, Matt, I think that's a great question. I think the first thing when you just look at the emerging market small cap valuation, they right now are trading at a discount to the emerging markets, the large ones. They're at 1.5 times price to book, where the emerging markets is at 2 times. Their PE basis is slightly higher at 18.5 times versus 14 times. And their profitability is lower. That is typically what you'd expect because a lot of them are still kind of in an emerging stage. But I think here's the key point, Matt. If you look at in the U.S., if you look at small cap, it trades at a huge premium to large cap. It historically always has because of the growth rates. But in this case here, in the emerging markets, a lot of these, it's an asset class that people haven't easily been able to get their hands on. Now you can get it through, State Street has the EWX and Wisdom Tree has the DGS. So there are available ways, and I think that it should be an integral part of people's portfolios. Keep in mind, though, when you go through these outflow periods and political stress periods, they're going to get hit. So the small cap are down about 10% year to date, where the emerging markets are down 6%. So they are going to be more volatile, but you would hope that you can make it up on the upside, which you did in 2010. They significantly outperformed the emerging markets. So that is one, and we also like looking mid-cap in the U.S. has actually been one of the better performing places, better even than small cap, contrary to what people believe. And we're looking for more product development in the mid-cap space in the emerging markets too.
Interesting, and you are starting to see that a little bit. I think in Brazil and a few other markets, you're getting some mid-cap stuff, but I bet that'll expand in the years to come. Let me ask you a slightly different question. You rely on a lot of statistics and a lot of accounting points in your analysis. I saw, for instance, PEG ratios. How much can we trust the accounting and the reporting in these emerging market securities?
Yeah, that is a hot button, and that's clearly been one of the reasons historically that the emerging markets have traded at discounts to the developed markets, because of not standardized accounting like we're used to here in the developed in the U.S. In addition, you've got, as you mentioned, the growth rates can be highly variable. We typically, on the growth rate side there, will look at the IMF, where you can get growth rates for the countries. And again, that's a free site that people can go to, imf.org, and you go to the statistics and data segment. We also use some proprietary information to get our growth rates and try to triangulate all the sources of information and come up with. But similar to the U.S., those growth rates, they're highly subject to variability and to revisiting on a quarterly basis. The accounting issue, what we'll do, Matt, is we look at, we have a source that we use that kind of gives us geopolitical and corruption and accounting factors that we can take into account, and we'll grade rank all of the countries, almost like the S&P's grade ranking them with BBB or single A or C-. We'll do that with the countries that we have and use that as part of our factor analysis to take discounts to the PE based upon some of those issues. I have noticed, though, in some of the more mature and developing countries, they are trying to get their hands around the accounting because they realize that is an issue.
Right, right. We have a couple questions that sort of point to that, and maybe you can talk a little bit more on that. How do you take something like a country like Russia, where maybe the data is very favorable, but maybe there are concerns about how great a market it is for investors, or concerns about governments, or concerns about future geopolitical risk. What do you do to monitor that, and when do you decide that you're just going to walk away? That it's just too risky? Yeah.
So I think clearly at this point, when you see PEs in Russia at single digits, I think a lot of the issues of the corruption, a lot of the issues of the interest rate issues that we talked about, that they have negative real rates right now that they're going to have to address at some point, have been more than, you're getting more than compensated. So what we try to look at is on a risk reward. We try to take every country, every sector that we're looking at, and get an idea that if we can't get at least 2 times the upside for the downside that's being provided, we walk away from it and have no interest in it. Because if I want, an equal bet, I'll go to Vegas and at least they'll give me a free cocktail and I can roll it for red or for black. But for playing with our clients' money, that doesn't work. So it's got to be 2 to 1 on the upside. And again, I think Russia actually, that other piece that I mentioned about the oil exports, that's a huge advantage that they have right now, with oil at close to $100 a barrel, that they can continue to have all this cash flow coming in and helping the country clean up its balance sheet and have a big rainy day fund that can take care of other issues.
Right. Interesting. Yeah, no, that makes some sense. Let me ask a specific execution question that we've gotten from the audience. I spent some time on how do you approach trading and getting a fair price. Let's say you decide to make a significant investment in one of these ETFs. How do you go about executing that order and getting the best execution for your trade?
Yeah. So one of the things that we do is my background, part of my previous background was running sales and trading at Bank of America Securities. So on the trading side, we are extremely comfortable. What we do, a lot of accounts that we have are custodied at the TDs and the Schwabs. So typically, you've got to rely on just doing electronic executions. Before we'll go do the electronic execution, we'll do a lot of the check pieces that you talked about, Matt, making sure, trying to get an idea on what the right price should be. But then we'll do a second test, and we'll go out to street connections that we have, whether they're Knight Securities or Susquehanna, and you can get an idea on where liquidity actually lives at that point. So that's a very important check piece that we will do in our analysis. And as you mentioned earlier, a lot of the content providers are quick to point out, listen, in creation sizes, which is 50,000 to 100,000 share lots, which most people are not going to be executing. In fact, we don't even. When we have large accounts that come in, we tend to do much smaller bite sizes for putting the money to work or when we're selling. So what really matters to me is, where can I get a print for 5,000 shares? Where can I get a print for 1,000 shares? And again, that creation and redemption is not as important, so it really is checking all the liquidity providers that are out there on the street and then trying to come back to the TD and Schwab's and making sure that I'm going to put a limit. And that's the key with this. So everyone that's listening on the phone call, on the webinar here, you do not put market orders out for ETFs. These are just like stocks. You must have limits that you put on these. And as people found out in the flash crash back in May of last year, market orders, there's a reason why they call them an execution in Wall Street lingo. You will be executed if you put market orders out there. So if I can take you guys take anything away from this, market orders are a no-no. Limits are the way to go.
That's absolutely true. One question that we've had from a couple people are there concerns that some of these ETFs could end up sort of wagging the dog for small markets like Indonesia, or do you get worried about the underlying liquidity and what the price impact might be of the ETF in those markets?
Yeah, no, I think we definitely keep a very close eye on that, particularly in those ones that you mentioned, in the very, very illiquid ones, and more importantly, when you have heavy concentration of some of the individual positions that make up the ETF. So what we tend to do, we like to see, typically you like to see what the underlying liquidity as opposed to the actual AUMs in the fund, but the AUMs do matter a lot, and just kind of a ballpark number, you typically would like to see around $100 million of AUM in a fund. That's not a hard, fast rule, but if you have $100 million in there, typically you are going to get some, you're going to get enough liquidity that you can trade it. But yeah, you definitely, as we've seen, a lot of these providers, whether it's market vectors with Vietnam, they obviously, a lot of the positions that they have just have indirect exposure to Vietnam, not direct exposure where they're actually domiciled there. And that's how I think a lot of the ETF content providers have gotten around some of those liquidity issues, is finding ways to have indirect as opposed to direct exposure.
Interesting. We have time for one last question. So you put up a very interesting slide and talked pretty convincingly about maybe the attractiveness of the energy market writ large across emerging markets. Do you like the new sector ETFs that are popping up in emerging markets? Do you find those useful? Are those working into your strategy?
Yeah, we like them a lot, and the caveat with them, Matt, is that because there really hasn't been a big adoption rate from assets flowing into them, they're actually very difficult to be able to kind of build concretely into your portfolios. But that's starting to change as more and more people are starting to look at them and assets are beginning to flow into them, whether it's from emerging global or some of the other providers that are out there. We are definitely like those and hope that people will begin to adopt them.
Yeah. Same here. Well, I want to thank you, Kim, for joining us for this this Alpha Beta webinar. I think it was great. I want to thank the audience for attending. As a reminder, we will send you an email to everyone who registered for this webinar, alerting you to where you can download the slides on IndexUniverse tomorrow. More information about IndexUniverse is at www.indexuniverse.com. More information about Kim's firm, Main Management, is at www.mainmgt.com. I invite you to go to both websites. Thank you for listening, and we'll talk to you on the next webinar.
Thanks a lot, Matt. Thanks, everyone.